Now, for this first trade to make sense, we have to understand the context behind it. That way I could explain how I traded it and the strategy behind it. So in the pre-market plan, I post these every single day in the Invest to Trade community. The main thing that I was watching for was 5533 on the S&P 500. And again, this strategy could be applicable to any market, any stock, any future. Really what I was watching for was as long as this green box down here at 5533 could hold and is supported from buyers, that I want to play longs targeting 5548, which is this pink box above. So essentially, as long as the green box could hold, I want to focus on longs targeting the pink box. The issue with this was before the market was even open, we hit the level of demand and began to rally. Now, when the market opens up, this is when things change and I begin to find some buying step in. Now, after the buyers proved themselves to be very strong from bouncing off the demand zone, when the market opened up in the first 3 minutes, there was some significant buying volume that I spotted here at 5540, which enabled me to get long with a 1.5 stop loss and an 8 to 18 point reward. The buying volume here was significant. The market was consolidating and holding, giving me and validating that there were large buyers present in the market. So now keep in mind, I am long when the market looks like this, and directly after my entry, the market rallies up and it hits my supply target, and I scale out along the way at 5552 for a 12 point reward off of 1.5 point risk. Looking at this chart right now, I want you all to notice how fast this worked out, and the market essentially moved in my favor directly after I entered the setup. And this is the crucial aspect to this strategy because it's one of my personal rules. Now, I don't want people copy and pasting this. I want traders to test this and see if it's something they find in their journal. What I've found in my journal is the best trades that I take. We're not even talking about dollars made. We're just talking about execution. The best trades that I execute are ones which work in my favor directly or shortly after I enter with very minimal drawdown. In this setup, entering at 9:33, the market moved up in an 8-minute period directly into my first target. Now, granted, I held runners. The runners didn't work out very well, but 8 minutes to make a $12,000 profit off of a 5-to-1 risk to reward ratio, risking $2,000 to make about $10,000 or more. Now, if you were to look at my running P&L here, and this is the basis to my strategy, is there was not once that I was in this trade that there was ever drawdown or was I ever red on this setup. Directly after I entered this trade, the market continuously moved in my favor without ever pulling back on me, without ever putting me in the red, and I was consistently and always in the green on this setup. So one of my rules and something that I've noticed is the best trades go in profit quickly with very minimal drawdown. Now, that's not to say that I will always be green on my setups, that I'm always going to make money. I lose on them. And there are some trades that I enter that go slightly red on me that eventually turn green and turn out to be winners. This is just based off of a sample size of my data and what I've noticed to be a common denominator from the best trades that I take. The best ones go in profit quickly and offer very minimal drawdown. Why is this the case? This is very strategy dependent. For those who follow me, and if you don't, I recommend subscribing to my channel. And also, if you find value in any of my videos, I would just really appreciate a thumbs up on this video. It would take 2 seconds for you to do that. But if you're new or you have been following me, my strategy is built upon the urgency of large traders getting in a position or being forced out of their trade by what I call max pain. I've always said it that where there is pain, there is gain for others. So I am looking for pain because that's when I know a great edge will be present in the market. So essentially, I'm just trading with larger participants. And due to this, trading with big money, smart money, and traders with large size, my best setups usually go green fast and should pay me relatively quickly due to the market favoring my trading thesis and my plan. I will sometimes know that I am not in a great position if the market hangs out or consolidates because I know the best trades that I take, the ones with very minimal stress and the ones with a large amount of profits, usually work out fast. And that's because how I was viewing the market and my analysis is validated by the information the market is presenting to me. And that is essentially how I trade and the things that I look for. For example, this was a trade that I took earlier this week on June 24th 25 full-size ES contracts. Again, not very relevant. What's relevant is my risk. On this trade, I was risking $2,500, and I came out with a $17,000 profit. This trade from my entry at 9:50 to my exit at 9:59 lasted 7 minutes. And if you were to look at this chart, from my entry to my exit, the market did not ever put me in drawdown. Yes, we pulled back. Yes, we consolidated, but the market moved in my direction pretty much directly after I entered this setup. Now, granted, I sold this trade too early and I could have got another 15 full-size points on the S&P 500, but my plan was followed. My risk to reward was great, and this was a good setup due to how I confirmed the trade with large buyers and due to how fast it worked out going into my target. This validates that my best setups go green fast and should pay me relatively quickly due to how I am reading and viewing the market, following my trading plan and my trading thesis. If time is passing and I'm not making money, which is also translated to the market's just moving sideways, it's consolidating, it's very balanced, it's very flat, then this tells me the urgency is not there and my original thesis may be incorrect. If I see the market moving sideways, then how I viewed my confirmation piece. Carmine, why did you enter here? Well, Carmine, maybe I entered because there was large buying here. Well, if there's large buying at this level, then the market should rally and move up higher relatively fast. But Carmine, maybe you're viewing it as large buying, but now the market is moving sideways and we're not rallying up and we're consolidating and we're just stagnant, hanging out at these prices. Well, then Carmine, maybe you need to reevaluate yourself because your original thesis of how you confirmed large buyers here may be incorrect. And it tells me that the urgency of those large buyers are just not there, and my thesis may be less likely to play out, or I just simply may be incorrect on the trade. For example, on the 25th of June, what I was watching for was the same level at 5527, which is this green box here, that if buyers cannot get above 5527, which is resistance, then it's likely we're going to sell off and a short thesis is in play. So when the market opens up on the S&P 500, there were 5 trades that I took this day, and all 5 trades were unsuccessful. What I kept doing was shorting the pops and shorting the rallies higher. For example, I was shorting this pop, and what I do is I get in short when the market rallies up. 5526, I was in short with a 2-point stop loss. If you know me and you follow my trading, my losses, I go for at least a 2-to-1 or better risk to reward ratio. This was about a $1,000 losing trade. My planned risk was a 3.5 R. My planned loss was about a $2,200 loss, but I sold this position for a $1,000 loss. Now what this looks like here, and I was going for basically a 6 to 10 point reward on this setup. The market moved up, we hung out a while, we consolidated. If I am short, I'm expecting the market to sell off relatively quickly. Almost look in the sense of terms of illiquidity. If I pay a good price for the market, short or long, the market should not really hang out there. A bad price is where there's a lot of trading. A good price is where there's very little trading. In this example, when I see consolidation, it's indicating that my thesis and my analysis of those sellers that I thought were spotted here is invalidated, and I most of the time get out to protect myself for a smaller loss. The same thing occurs later in the session. Later in the session, took another trade short. Market rallied up. It was about a 2-point stop loss, going for a 5 to 10 point drop to the downside. Same plan, same thesis. And pulling up the chart here, this was a $1,500 loss, 3.5 risk to reward, and the same exact thing happens here. If you look at this chart, the market consolidated. The red arrow is my entry. The green arrow is my exit. The market technically moved down, but we hung out, we consolidated, and my original thesis and my original plan of spotting sellers there really might not have been correct to begin with. And I could go through 100 other charts, looking at all my losing trades. Majority of my losing trades, how I'm confirming the setup in this example, this was shorting sellers from the stronger drop, did not work out on me, and really was never green on me, and the market stopped me out for a loss. My running P&L was slightly green, and then we started to go in some drawdown, and I covered this trade prior to my stop loss hitting. And this is a portion of my risk management system that enables me to exit the position before my stop loss hits. Now, I'm very one to recommend beginner traders to always follow their plan and always follow your stop loss, always follow your target. But for me, these are my personal rules. And for me to be transparent about my trading, this is what I do. Now, if you want to implement it, test it before you go with real money. Trade with small size, because these are things that beginners really have trouble with, is that's following their plan and managing their risk. For me, I don't mind exiting my position before my stop loss only when I am scalping, because this results in smaller losses than I originally have planned for. For example, this was a break-even trade, a planned 2.6 R multiple. As you can see, I was in this trade for about 3 minutes and I exited this trade for break-even because the market really wasn't doing what I wanted it to do, and I was spotting buyers, but the buyers were not bringing the market higher. Essentially, what I saw here was the market moved up. We were holding 5527, the same level that I've been mentioning in all of the trades so far this week. I get in long right here, 2-point stop loss as always, going for a 7 to 9 point reward. Great setup, right? We were spotting the large buyers that were defending the market and getting long. Valid entry, valid stop, valid plan. But the market then pulled back on me, and instead of holding this to 5524, which was my original stop loss, which was right here, and I would have stopped out of this trade for a $3,000 loss if I was wrong. So this is like a risk management system and tool. I would have exited this trade for a $3,000 loss, but I exited this trade for a break even. The only way this will work is if you have the analysis in the back of your mind and the thought process to re-enter after you exit for a loss. What a lot of traders do is they cannot re-enter a setup after they lose on it. They translate a loss for their analysis to be completely wrong. Sometimes your stop loss will hit, or sometimes you will lose on the position, and the best time to enter is when you would normally stop out. So if you exit at your stop or you exit before your stop loss, always plan for your original thesis to still come true and have the thought of re-entering. My best setups too also come from re-entries after I miss time the first or second entry. Maybe after the second or third one, it works out where the first two don't. Sometimes the re-entries are the best setups. So in this trade, after exiting for a break even, I simply re-entered this setup. 2 minutes after I stopped out of this position, I got back in long with the same plan. 2-point stop loss, 7 to 9 point reward. I was spotting the buyers in the market, and the market eventually rallied up, scaled out of this position, and this trade never went red on me. It was constantly green on me. Yes, we pulled back, but I never was in drawdown, and how I confirmed this trade was validated by the market going away from my entry relatively fast. When I am getting a good trade and I am paying a good price, the market moves away from that relatively fast, and that's how I know I am taking a very good scalping setup. So if you want to exit before your stop loss and you want to listen to Carmine without testing it and putting your real money into play without collecting data, then understand you have to have the mental fortitude to re-enter after you stop out, because never throw in the towel on your analysis. If you're spotting buyers or you're spotting sellers, take the damn trade as long as your risk is managed and you're finding opportunity, right? Even if I took a $3,000 loss on this setup and I didn't protect myself and I got out at my originally planned stop loss, well, the next setup was double my loss, so I would have had even more money in my pockets, but I re-entered the setup and I didn't have a losing trade. Throw out my analysis in the window saying, oh, I lost on it. I must be wrong. The market should go down. I always am looking for opportunity and I am managing my risk. And here's another trade this month. This was with 15 full-size ES contracts. $2,000 risk, $15,000, $16,000 profit. Entered at the low. How I was viewing the buyers and how I was reading this was correct because the market rallied directly after I entered this setup, and it worked out very well on me. Now, this doesn't mean that the market's not going to pull back on me. This doesn't mean that we're going to have a rally if I'm short. This means in this trade, I was long down here. Market rallied up, pulled back on me, and I was about break even on this setup about 5 minutes after. So just because the market's pulling back on me and I'm going break even Doesn't mean I should get out of this trade. This is not the concept of this video. The concept of this video is understanding that how I'm confirming the setup due to how my strategy is built, the urgency of large traders should make the market move in my direction relatively fast due to how I am getting in and out of a position from max pain or just large traders defending a specific price point. This doesn't mean that I will ever have a drawdown trade go green on me. That's completely false. There are trades that are red that turn green, and this doesn't mean the market's going to move straight up into my target. This simply means how I'm confirming my thesis and how I am validating it is true because the market moves in my direction relatively fast. Now go back, look at your best trades, especially if you're a scalper, and see if you see common similarities as that. You know, like looking at this chart today. If I was short at the highs on the S&P 500, and we could even look at the buying pressure up here, right? Here you could see max pain. What I mean by max pain is you could see a lot of trapped buyers, which is green buying volume at the high of day. So if I was short here at 946, right? Keep in mind 946 Eastern time, and the next rejection up here, which is around 10:15 Eastern time, right? The market had sold off. You could see red selling prints come in relatively fast. So if I was short at 946 and I had a thesis to short this today, the market sold off relatively faster. So how I was reading those sellers at the high was correct because the market didn't really let it hang out there and transact a lot of volume, indicating that this is a fair price for other participants to pay. For you to get a good price, there has to be very little volume trading there because it gives the market not a fair opportunity for other participants to trade around, and that is where the biggest edge for me comes in. If you entered at 10:15, 10:16, right? Minimal drawdown, the market pulled back, and yeah, look, here we have a pop right here. So yeah, depending on your entry, maybe you were red on it. Maybe you were break even after this little pullback up here. Number one, your stop loss never hit. And number two, the market moved in your favor directly after you entered it. And then eventually we get the sell off down. We could even talk about this high up here. We could even talk about this low down here. You know, so it's all about perspective. I want you all to test it, look at it. But this is how I know I take good setups and how trades are going to last me 5-10 minutes and make a 5-figure profit in 8 minutes. In the first 20 minutes, the market was open, and go enjoy the rest of my day. That is the freedom behind the market, and that's something that my strategy enables me to do. Take a setup. I know it's a good setup. Make money on it, and go enjoy the rest of my day. So I'm going to end it on that note. I would appreciate a thumbs up on this video, comment any questions, and if you're new to my channel, I would really appreciate it if you would subscribe. Peace out.